Okay, gonna wait a few seconds. Good morning, everyone. Thank you for joining. We're gonna wait a few more moments for a few stragglers that are going to be joining us, and then we can jump right in. Okay, let's get started. Again, thank you for taking the time to spend an hour talking about our future, which this presentation is really about. As we walk through it, we'll be talking about how to protect ourselves from a likely debt crisis, and what that means for not only the nation's future, but us personally and our families. I've been studying this issue now for about a decade, and been following some of the leading thinkers on this issue. And I'm going to present mainly the facts and the data around our national debt and deficits and what the implications are for that. The reason I'm focusing on this and why I've decided to, not only write a book about it, which I did, but also now starting to give webinars, is because I think it's the biggest risk to our nation. I think it's a bigger risk than war. I think it's a bigger risk than epidemics. We just went through one. And I think, the data that I'm going to present and some of the leading thinkers and their voices I'm also going to share are going to lay out a thesis for why and this is a real risk and a real threat to our future, and especially the future of next generations. I have a family and children, and I want to protect them. And so the best way I have figured out how to do that is to start, the process of educating as many people as I can. Because as a whole, there's a lot of smart people who are warning us about this issue, and we tend to ignore it. And we're ignoring it because of what I call normalcy bias. So let's jump on it. I'm going to allow 10, 15 minutes at the end for questions. And so if you do have any questions, you can just type it in to the application. You should see an area on your screen there where you can type in for questions. You can type in the questions at any time. At the end of the presentation, I'll review those questions and answer as many as I can. So, U.S. debt. Will we solve this, and will we solve it through an organized, solution, or is crisis going to solve it for us? And let's sort of get into the data here. So we have about 35 trillion in debt, and which is about 15% of debt to GDP. And that's a critical metric. If you listen to most economists, the metric of debt to GDP is one of the things they look at. And the reason for that is it looks at the burden or the load of debt against the nation's income. No different than you sort of would do that personally, right? You look at your personal debts and what the cost of those debts are versus how much money you make every year. So let's say if you made $100,000 a year in income, but your debts were costing you $115,000 a year, that would be a critical threshold. That's a good example of why they look at debt to GDP. So we now also have annual deficits that are adding on to the debt of about $1.5 to $2 trillion a year. And this is what I'm looking at, right? Which is another approximately about 5% of GDP we're adding annually. Why that's a critical threshold again is because our GDP is growing at about 2.5%, 3%. Let's just call it 2 to 3% annually without any recessions. But the debt's growing at 5%. So the debt's growing faster than GDP, which means that every single year, our debt and deficits are growing, and it's adding to the percentage. So we're not improving, we're deteriorating, and it's getting worse. So we're already beyond historical debt levels, and these levels of debt historically with other nations have triggered crises. Now, we're in a lucky and fortunate situation where we have the world's reserve currency. We print our own currency. We've got the world's largest economy, and people have confidence in our bonds right now, so that it hasn't led to crisis yet, even though we're at a beyond 100% debt to GDP, which is that clear metric. And so we've got these sort of safeguards that I just mentioned that have given us time. And we do have time. The problem is, how much time do we have? So where are we headed? Reinhard and Rogoff, who are two leading economists, wrote a book titled "This Time is Different." And their data is what I'm about to present next. And one of the things they mentioned is that our Federal Reserve and our future is going to be limited by our monetary fixes. What I mean by that is the Federal Reserve usually has tools that they use. They can increase interest rates, they can lower interest rates to stimulate the economy, or to, let's just call those, Federal Reserve tools. They use those tools, but when we have more and more debt, the implications of that debt limits their monetary fixes or the monetary tools that they have. And that has a real serious implication on our future. And all of that comes together in what I call the great conflux, and where we now have forces coming together that we've never seen before. First time in our nation where these forces are coming together that are going to have greater implications. Let's talk about that a little bit. So, Reinhard and Rogoff, they're economists, to understand how important these thinkers are and where their expertise lies. These are just not average economists, right? These are economists from Harvard, Columbia, MIT, have worked for the World Bank and the IMF. So their experience is broad, deep, and they're the leading thinkers when it comes, some of the leading thinkers when it comes to national debt and deficits. And this is one quote that I'm showing right here from their book, and you can see here, I've got a capture of their book to just reference it. That when we have excessive debt, we've crossed critical thresholds, and those thresholds we've crossed are consistent patterns across centuries of data that have shown that once you pass 90% or 100% of debt to GDP, that's a tipping point. Growth begins to slow, the risk of crisis begins to rise, and the further we get out beyond 100% debt to GDP, the more risk we have. And so when you look at history as an example, when you look at Reinhard and Rogoff's data and what they presented, it's pretty clear that you can't keep going down a path that's going to lead to crisis and just ignore it, which is sort of what we're doing. And this next slide sort of, compounds the problem. So the great conflux, we've got multiple things happening for the first time in human history. We have an aging population. right? We have more retirees and less workers funding the system and paying taxes. We have entitlement strain. Social Security and Medicare are going to be insolvent right around the next decade. So we have about 10 years before those two entitlement programs do no longer have enough funding to pay out what is owed. If you look right here, that shows you when we will be unfunded for these two major entitlement programs. And that's going to add significantly to the debts and deficits. And I'll go into that data in a second. And so today we already have an annual unsustainable deficit, right, in the trillions of dollars. $1.5 million to $2 trillion we're adding to the debt every single year. Now, you combine that with a savings crisis. Our savings rate as a nation is the lowest it's been in history. So the average individual or the average family has very little in savings compared to history. So there's not much cushion. And then on top of that, we're also living longer. You know, we have an aging population, but we're also living longer. You know, average life expectancy 100 years ago was roughly 55. Average life expectancy today is 75. If you look at the data, average life expectancy is going to be 90 to 95 for a generation that's being born today. So we're living longer. We actually need more savings, but we have less. We're adding to the debts and we're adding to the deficits. And we have that also as a looming threat. So we have this, what I call the great conflux, which is all of these risks coming together at a very unique time. And we're not solving some of the issues. And that's the overlying concern. Let's get a little bit deeper. So here you can see the green is our annual debt. That's how much debt we've gone into every single year. The red you can see is actually a surplus, meaning in that year, we did not have any debt. We actually had a national surplus. So you could see that basically almost every single year for the last 25 years, every year we keep going more and more into debt. Here's the bigger problem, right here, off-balance sheet debt. That off-balance sheet debt, which is about $50 trillion today, is what Medicare, Social Security needs to be solvent. So in about 10 years, we as a nation have to figure out how to come up with $50 trillion so that Social Security and Medicare is fully funded. And those recipients get what they're entitled to. If not, we are going to have to cut those entitlements. And that's a really, really large issue, both politically and at the populist level. So if we have to come up with $50 trillion and we add that on to the current 35 trillion, and remember that's growing every year. So in 10 years, that 35 trillion is probably going to be closer to 45 trillion, maybe even more. But let's just use the 35 trillion to be conservative. We add 50 trillion on top of the 35 trillion. We're at basically 85, 90 trillion dollars in debt against around $35 trillion of GDP. We're at 200 to 250% debt to GDP. That will lead to crisis. So we combine all of these issues with what I mentioned earlier, our savings rate. Here's a graph of the savings rate. You can see back into the 1960s, 70s, we had about a savings rate of about 10%, 12% on average. It slowly started declining when we got into the 2000s. The gray areas, these are all our recessions. You can see that we had a big spike here, and that spike was COVID and all the distributions that the government made out to individuals spiked our savings for a short period of time. These were all the checks the government was giving out to individuals during COVID. And those savings were spent very, very quickly. And now we're back down to this level here of about 5 to 4% savings rate, the lowest we've seen in 50 years. So this savings rate is also a great concern because that's a cushion, right? If there is a crisis, does the average family or individual have enough savings to get through a crisis? We don't. Now, let's look at the debts again and understand why the debt at this level is now so complex and why it's a structural problem now. So you can see here that in the 1930s, 40s, 50s, we had less than 1 trillion in debt. It was relatively under control. We get into the 70s and it starts spiking. And then, we get into the 2000s and it just goes parabolic. And you can see now, I've categorized this by administration. And the purpose of that is really to show that this is not a partisan issue. It's no longer an issue of Republicans or independents or Democrats. Every party is adding on to the debt, basically. We don't have a party that's really focused on fiscal control. And there's a reason for that. You can't get elected today by saying that you're going to raise taxes and you're going to cut costs and you're going to cut entitlements. And that's what's needed to fix this problem. When we had a debt to GDP ratio of 20%, we could have probably just raised taxes a little bit and we would have solved the problem. It was an easier fix. When we were at 50%, we could have probably raised taxes a little bit, lowered entitlements and costs a little bit, and fixed the problem. But when we're at 120% or 200% debt to GDP, there's no easy fix anymore. It's going to be very, very painful. We have to raise taxes dramatically. We have to cut costs dramatically. And no one can win an election under that platform. No one. So it's not politically popular. And so everyone now is just ignoring it. And that's why you can see administration after administration after administration who wants to win an election is now just ignoring the debts and deficits. Another great example of this is we have the debt ceiling, right? The debt ceiling is meant to make sure that we don't keep adding on to our national debt without some type of controls or measures. You'll hear about it every 6 to 9 months that Congress increases the debt ceiling. We've done it now about 80 times. It's a useless measure because every single time the debt ceiling comes and we have a discussion about it and the government's going to need to shut down if we don't increase the debt ceiling, all that happens is they vote, they increase the debt ceiling, and we add on to our debts and deficits. So we don't have any measures in place politically to really protect ourselves from the debt or deficits growing. And it's not politically, you have to be sort of politically insane to try to be elected under a platform, as I mentioned before, of higher taxes, lower entitlements, lower costs. And by the way, if we were to do that, increase taxes, cut expenses, cut entitlements, that would put us into a recession. So there's this double-edged sword here. And so I'm trying to explain the complexity of the problem and why politically there is no solution here. It has to be a populist solution. The voters have to want to solve this problem and accept the pain that comes along with it. And the voters don't want to do that. It's what I call sort of this next slide, normalcy bias, right? People just want to feel normal. People just want comfort right now. They don't want to vote for pain. And I get that. The problem is so big, there's no easy fix anymore, and voters are not going to vote for those hard solutions. And so, too many people focus on this and they say this is a political problem. It's not a political problem. It's a populist problem. We're not going to vote for people who are going to run on a platform that says, yes, I'm going to increase your taxes. I'm going to lower your entitlements. We're going to, make the government smaller. You're going to have less Social Security. You're going to have less Medicare. You're going to have less support. And we're going to go into a recession. No one's going to vote for that. But that's the only solution to this problem right now. And I'll even demonstrate this more by some of the leading thinkers in our country, some of the smartest people around this issue, some of the deepest thinkers when it comes to finance, debt, and our economic environment are warning us, but we're ignoring it. Here's some of the leading thinkers on this. Jamie Dimon, who's the head of JP Morgan, the largest US financial institution, one of the largest financial institutions in the world, is saying that this is the dangerous time, and he's talking about the debts. Jerome Powell, who's the head of the Fed today, is also warning us about our federal budget. And that's unusual for him because, debts and deficits really aren't his mandate. As the head of the Fed, he has a dual mandate of inflation being under control and full employment. But when he's warning about debts and deficits, which are outside of his mandate, he thinks it's that important of an issue that he needs to warn the nation. But we're ignoring what he said. We can look at the Congressional Budget Office, nonpartisan. Congressional Budget Office is meant to just advise Congress about the health of the economy, about data, and forward-looking projections. And you can see what they're saying about the debt. Ray Dalio, which has built one of the largest financial institutions in the country, one of the largest private equity firms and hedge funds, and a leading thinker when it comes to debt. He's also pointing towards chaos. The Peterson Foundation, which is a foundation strictly focused on our national debt, they have a lot of data, a lot of economists on their board. I really suggest people to go onto that website and look at what they're presenting and some of their thinking. They are also warning us about this debt. So, the hard truth of it all is that we've got no political solution. We've got both political parties that are being really fiscally irresponsible. They've realized that if they want to get elected, they just need to make promises and then not worry about how to pay for those promises. And the voters are demanding for, greater entitlements and don't really recognize that those demands of, those promises that the political parties are made for, one day we got to pay for those. And right now we're paying for them by going into debt. That doesn't make a lot of sense. We do have a failure of leadership, and that normalcy bias that I was referring to, which is like, I don't want to worry about this. Right? I just want to be normal today. This is a problem in the future. Here's a good stat for everyone. The Pew organization did a poll, and they asked, what percentage of the US population is worried about our debt and deficits? 85% of the population said they're worried about it and they think this is a real issue. 85%. But that 85% is not willing to vote for changes to fix the problem. Some of them are willing to agree to higher taxes. Some of them are willing to agree to lower expenses, cut costs, cut entitlements. But you can't solve the problem with one or the other. Here's a great example. We have about $1.5 trillion in deficits annually today. 1.5 trillion. If we were to cut the entire military budget, so we have no military, zero, we would still have about $800 billion a year in a deficit. That's how big the problem is. If we were to cut out all discretionary spending, all of it, so all the military, we have no money for roads and infrastructure and bridges. We have basically no police force. We cut out all that discretionary spending. We still wouldn't have enough money to cover an annual deficit of $2 trillion. That's how large the problem is. Washington can't fix this. We have to fix this at the voter or the populist level. And that normalcy bias, as I described it, is not going to do it. So we're at a crossroads. We don't have a political solution. We don't have a populist solution, meaning the voters aren't going to vote for pain. So we have to do it down at the individual level, which means that I believe, and what I'm preparing me and my family for, is a future crisis. Because if we don't fix this, crisis will. And that's what Reinhardt and Rogoff showed. They showed that once you get past to 100%, 90% debt to GDP, eventually crisis solves a national debt problem, one way or the other. And it's usually through either inflation or a monetary crisis or a bond crisis, the last two being relatively the same. So if we want to really look at the data and not put our heads in the sand and say, okay, yeah, this can't continue on. We can't keep adding on to the debt every year with more deficits. Eventually, that is going to lead to crisis. People need to protect themselves. And that's one of the main reasons why I take my time today, really, to start educating people, not only my family, not only my friends, but the entire nation if I can, because I think this is the greatest threat to our country in the next 20 years. A lot of people ask me, and they ask, Reinhardt, they've asked Rogoff, they've asked Dalio, they've asked Jamie Dimon, when do we think this crisis is going to happen? The real answer is nobody knows. The reason we don't know is because it's an issue of confidence. It's an issue of when does the rest of the world no longer believe that we're going to be able to pay our debts or deficits, no longer have confidence in our bonds or our currency. And that crisis or that flashpoint, we don't know when that really happens. Right now we have time, as I mentioned earlier, because the world does have confidence in us. They do have confidence in the dollar. They do have confidence in our bonds. They do have confidence in our economy. And thank God we do have that time. How much time we have, no one really knows. If you listen to Ray Dalio, he thinks we probably have 5 years, give or take. If you listen to Jamie Dimon, he thinks maybe 5 to 10. My prediction is, somewhere in the 5 to 20 year range. And so it's one of the reasons why I really educate my children on this, because this is likely a greater issue for them than it is for me at my age. So what am I advising my family and friends to do, to protect themselves? I've got these guiding principles, which is, right, just take responsibility. Don't look for a political solution. Washington is not going to fix this problem. You need to start thinking very, very long term, because you do have time, and you should be thankful for that time because it allows you to prepare. You need to diversify yourself so that you spread your risk. You have multiple income streams, and you're not relying on any single institution for your savings. And you got to preserve flexibility. To go into a little bit more detail about that, what does that mean really to diversify? You should be spreading your assets across industries, geographies to reduce single risk, because when the crisis comes, it's not very clear how that crisis will transform. If you look at Reinhardt and Rogoff's data in their book, national debt that has led to crisis has a couple of pathways. It can be hyperinflation. A country can hyperinflate their currency to get out of debt, but that's very, very damaging. Seeing what inflation has felt like, and that's modest inflation compared to a debt crisis, and what those inflationary levels would be. So this crisis could mean that we've got and I mean hyperinflation, or it could mean a bond crisis, and that could mean, really, really high interest rates, which is also very, very damaging. Or it could mean default. I think default's unlikely because we control our own currency and we'll just print to infinity to avoid a default. But printing money, especially when we start printing at hyper levels, that will lead to hyper levels of inflation. So it's really hard to forecast accurately how the crisis unfolds, and that's why diversification is really important. The second item, I think, is the most important thing: multiple income sources. You need multiple streams of income so that if you lose one, you have two or three to replace that. A simple example is if you lose your job and you're not able to get another one because we're in crisis, you want two or three other income streams to help support you to get you through the crisis. Going back to that issue of the low savings rate, we don't have a large savings rate in the country to get us through a crisis. So we need other income streams to do so, which means really that we need more discipline in the country. We need the country to save more money and start investing that in other income streams so they have dual income streams. They don't. About 90% of the country has a single income stream and very low savings. What people can do is, put things in inflation protected assets or income. Hard assets is a really good example of that. Some foreign currencies are a good hedge as well, especially foreign currencies where they have low debt levels and they have stable economies and a strong job base. I'm not going to give specific recommendations because I'm not a really a financial advisor. That's not my core competency. But going out and researching stable foreign currencies is not that hard. Diversifying banking relationships is also really important. We don't know which banking institutions will survive a debt crisis. So leaving your savings in a single bank is probably not a really good idea. And the last item, which we mentioned, hard assets historically, gold, commodities, tangible assets, are really good inflation hedges and also provide that sort of dual income, or the multiple income streams. And so those hard assets that are income producing inflation protected are also a really good place to be. So coming to the end of the presentation, just some final thoughts I wanted to share, which the reality we are in is we've got a structural debt problem now. And what I mean by structural is what I've sort of shared in the presentation, which is there's no easy fix anymore. And we have now annual deficits. If you look at the forward-looking projections from the Congressional Budget Office, they're showing annual deficits as far as they can project out. So the Congressional Budget Office is basically saying that we're going to have annual deficits every single year unless we make some changes, and there are no forecasted changes really. So the debt is spiraling, and it's not going to be stopped by the voters or our leaders or any political parties. Crisis, from my perspective, and some of the leading thinkers that I mentioned earlier, looks like it's inevitable. And waiting and hoping that it's not going to happen, that's not a good strategy. You know, something I say a lot inside our firm is hope is not a strategy. You know, hope is a fool errand. You need to prepare. Even if that means preparing requires some discipline and some hard choices. You know, we have to take responsibility for our financial future. We cannot rely on anyone else to do that for us. We cannot sit here and continue to blame the politicians for a weak economy or inflation or debt or our deficits or our future. They're not going to be able to fix it for us. Our path forward is responsible citizens who are going to be disciplined, who are going to save more, spend less, and protect our future. There's going to be a large percentage of the population that's not going to do that. One of my greatest concerns is there's a lot of people out there just struggling right now to make ends meet, to just pay the rent, get enough food on the table. It's hard for them to save. I feel their pain. When people ask me, what do I do when I just can't save? Every penny I have left just goes to meet the basic necessities. I tell them, you need to get a second job. As hard as that is, you need a second job. I've had 2 or 3 jobs my entire life. I put myself through college working at California Pizza Kitchen as a waiter. And then I got a second job working for Glenfed Development as a gopher. And then I had a third job selling baseball cards at conventions 3 or 4 times a month. So I had 3 jobs in college. After college, I also had 3 jobs. Even today, I've got basically 2 jobs. I run my firm, and then I've got a second job, you know, making sure I have multiple income streams outside of my firm. So as hard as it is, yeah, working 2 or 3 jobs is the solution for a lot of people. And I know that's not what they want to hear. But if you believe that crisis is coming, it's better to prepare for it and work hard now than not be prepared and have to go through the crisis without that protection or safety. So I'll take a moment now. We've got a few more minutes, about 10 or 15, to take some questions. And I'm going to have someone help me. Where do I go? How do we get to the question section? Let's see. There, Cuisinart. So The webinar will be recorded, and if you want a recording, we will send it to you. All you have to do is just email us, and we'll be happy to send it. So there's a question about diversification and how you can diversify so that you're not sort of tied to a single market. And I think that's a wise question. So as an example, you can invest into the stock market, and that the stock market as a whole broadly, that would be a single market in a debt crisis. Why I say that is the stock market, when the debt crisis comes, is going to be severely impacted. The reason is for it, we're going to be in a recession, if not a depression, and majority of those corporations, their dividends or their income are going to get impacted. People are going to be starting to pull money out of the stock market and the bond market to get liquidity, and it's going to have a severe impact on those, income sources. So I would tell you to be wary of, the stock market broadly. There are going to be probably individual stocks that are going to perform really well in a debt crisis. Picking those are going to be challenging. So I would be thoughtful of not having a huge concentration of your savings in either a single stock or just the stock market broadly. Diversify beyond the stock market. So if a question comes in is sort of in a recession or a crisis, one of the questions is, what industry assets, business models do I prefer? I mentioned that earlier. Having multiple income streams is really, really important. I mean, that's the biggest advice I would give to anybody. Hard assets, income producing hard assets are going to be likely your best protection. There's something called TIPS, which are basically bonds that are inflation protected. That's one example of probably 7 or 8 assets that I think are, likely to be protected in a debt crisis. And you can buy TIPS, which are just inflation protected bonds, easily on multiple markets. But that's one good example of an area. Other sort of, again, income producing hard assets are likely to also be good sectors to be in. Their questions is sort of about delinquencies and defaults, specifically around like credit card debt and other sort of consumer related debt. Credit card debt and defaults are going to spike to astronomical levels. We're going to see financial institutions under a lot of pressure. We'll see certain financial institutions fail because of not only their debt levels, but the default rate, meaning consumers who are defaulting on their loans, businesses who are defaulting on their loans. And so we're going to see a lot of stress on financial institutions with several failing. One of my reasons, again, telling people, right, don't have all your money in a single financial institution. Diversify your savings across several financial institutions, because it's going to be hard to predict which financial institution would fail. Some are going to fail just from credit card delinquencies. Question is, would you buy certain assets all cash? I don't know when this crisis is going to happen. I don't know if we're 3 years away or 20. And so buying things all cash, I don't think that makes sense. But I wouldn't, highly leveraged. As an example, inside our firm, we used to have a mandate, an internal metric that we would not surpass 70% debt to the value of our assets. We've lowered that 70% down to a 45% target. So now we want our portfolio to only have 45% debt to value and also a certain debt to our current income. So we're being more conservative with our debt levels and we're bringing it down dramatically. My guess is in the next 5 years, we'll change our mandate from 45% and we'll get down to 35%. So that the income from our assets, it far surpasses our debt levels, so that even if we have a crisis, and let's say our income and our assets drops 40%, we'll still have enough income not only to pay our debt, but to have surplus income on top of it. That's going to limit our growth. We have to be disciplined, and that discipline has a cost. And that cost to that means that we're probably not going to grow as much, but that's okay. I'd rather grow less, be more disciplined, have more security, and be prepared for the crisis. It's sort of the yin and yang of life. You do one thing and there's an opposite effect to it, but that's okay. We're preparing for the crisis, and lowering our debt levels is part of that. But that does not mean that we're going to no debt and all cash. The question comes into question about China moving off the US dollar and accelerating this crisis. That is true. We are the world's reserve currency. That has an important impact on our economy, and it is a supportive measure to us in general. If China were able to come off the US dollar, that would have an impact to us. I don't see that happening. That's my opinion. There's others who worry about that. Dalio, one of them, Hertzberg, another. There are some leading thinkers who worry about China, who is trying to come off the US dollar, being successful at it. So there's no clear answer here. There's opposing views. My view is that they can't do it today because there's no good alternative. Their currency, which is what they would like the world to pivot to, the world can't or won't. One, it's really not large enough. Two, they control their currency. It doesn't really float. And it's very hard to trade on a currency that doesn't float or that is internally controlled. And the euro is way too small. So there is no good alternative today. And thank the universe for that. That is also protecting and giving us more time. I answer a few more questions. I'm not going to be able to sort of answer them all. And I'll have a few thoughtful conclusions here. One more question that's coming through, which I think is a good one, is, maybe there won't be a debt crisis. And the person here is quoting actually the book. Maybe this time will be different. It's hard to argue with history. Every single time a country that has amassed too much debt has gone into crisis, it's just been a matter of time. Some countries have gone into crisis at 80% debt to GDP. Some countries, it took them to 250% debt to GDP. Here's a great example that people like to use. Japan is roughly today at about 250% debt to GDP, and it has not led to crisis yet. The main reason for that is they control their own currency, they print. They've had a relatively stable job base, but no one has really been buying their bonds for decades. They've been buying their own bond. It's a crazy concept, and I won't go into it right now. But Japan used to have one of the highest savings rates in the world, literally one of the highest. They have one of the lowest today. They've been using their own savings to be able to support their debt levels. So, and they've had what they call the lost decades. They've had decades of a stagnant economy. Their debt levels, created a loss of savings and a loss of growth in their economy. So they're starting to show signs of a crisis coming too. So this time won't be different. Our debt levels will lead us to a crisis. I'm sure of it. Some of the leading thinkers, which I've shared, and those are only a few. If you do enough research on this, you'll find another 20 or 30 very thoughtful, very intelligent, very educated people on this issue saying the same thing. We are in trouble. We're on an unsustainable path. We will lead to crisis. This time is not going to be different. Let's see. Last, question here is, how might this all affect consumer spending? It's a really good question because roughly 70% of our 70% of our GDP is consumer spending. It's an enormous part of our GDP. Obviously, a crisis is going to impact consumer spending dramatically. Hard for me to forecast or for anyone to forecast how much. Our best examples would be to look at the last recessions and see how much consumer spending was impacted by those recessions, and then increase that by 2, 3, 4x, because we're talking about a real debt crisis here. It's going to be harder than a recession. So consumer spending is going to be impacted. GDP is going to drop. And so we're dealing with, again, what I was referring to before, a conflux of issues that are coming together at the same time. So I want to thank everyone for your time. I hate to be the bearer of bad news. There's this expression that refers to, Mr. Doom, the individuals out there who sort of always, forecast doom and gloom, which has sort of never been how I think or my default mechanisms. But I looked at this information and this data for so long, and I'm listening to people who are smarter than me, who understand this issue greater than I do, who are in our financial systems and intimately understand our economy, our financial systems better than I do. And I'm going to prepare. I'm not going to wait for the populists or our politicians to fix this. They're not going to. And so sometimes when you see a crisis coming, you just have to prepare for it. A few things that do give me hope that we can all sort of rely on. I believe that we are a resilient nation, and when the crisis happens, we'll get through it, but there's going to be a lot of pain. I know we have some time, and those that use that time to prepare and be diligent and disciplined will get through the crisis with less pain. And I value that time a lot. It's just a question, will we use that time thoughtfully? My worry is a lot of people aren't, and I hope this data, this presentation, will help people to start thinking about it. I would advise everyone to please share the information. I advise everyone, go out and test. and validate this data on your own. Don't believe what I say. Go out and verify everything yourself. And once you've verified it, share it with your family, share it with your friends, especially share it with your children. This next generation is likely to pay for all of our folly, all of our overspending. This next generation, unfortunately, this younger generation that's coming up, is going to have to pay for the lack of discipline that we're showing today. And so, I don't let my kids stop thinking about this. Every one of my children has to take 10 to 20% of their income, no matter how small it is, and it goes into their 401k or their IRA. And their 401k and IRA is invested in diversified income sources. They're all income producing assets. My kids started 401ks or IRAs when they were basically 18 years old. And I force them to keep putting money into that because they're likely to have to deal with this crisis. If I were to put a probability about this, I probably have a 20 or 30% chance of dealing with this crisis during my lifetime. But my children, it's 100%. I would put it at 100% that my children are going to have to deal with this crisis in their lifetime. And so it's more important for them, just based on probability theory. So again, sorry to be Mr. Doom, but I hope the information helped. Please do share it with your family, your friends, your children. The more we can start talking about this and debating it as a nation, the more likely it is that we may come up with a fix and a solution. With that said, I wish everyone a wonderful day and weekend. I hope everyone enjoys the last bits of summer. And I will be talking about this more and more. If you follow me on any one of the social media applications that I'm on, you'll see that to almost nauseum, I talk about the debts and the deficits and this risk, and I continue to share more information. And so as I get more information, I do have posts. I do make posts about it. So you can follow me there to see what how my thinking evolves on this issue. With that said, we are out of time. I thank everyone again. And with that, we're going to sign off. Take care.